The winds of change are blowing across the economic landscape of the Eurozone, and the skies remain clouded with uncertainty. As the European Central Bank prepares to chart its course for the coming months, the latest inflation figures have thrown a curveball, forcing policymakers to navigate the choppy waters with utmost care. The air is thick with anticipation, as the ECB prepares to make its much-awaited move on interest rates next week. While a quarter-point cut has been widely anticipated, the recent acceleration in inflation has cast doubt on the path forward, leaving market watchers and ordinary citizens alike wondering what lies ahead. The numbers speak for themselves. Consumer prices in the Eurozone rose a staggering 2.6% in May compared to the previous year, surpassing even the most optimistic forecasts. The so-called core measure, which strips out volatile components like food and energy, quickened to an alarming 2.9%, sending shockwaves through the financial community. For the ECB, this unwelcome surprise comes at a pivotal moment, as it prepares to make its historic move, the first reduction in interest rates since the unprecedented spike in inflation that gripped the continent. While the central bank's officials have warned of an uneven path ahead, the latest data paints a picture of a journey far more treacherous than initially anticipated. Chief economist Philip Lane, ever the voice of reassurance, has sought to calm the waters, suggesting that a less restrictive monetary policy will be appropriate, even as inflation bounces around this year. His colleagues, too, have reiterated their willingness to act, their words echoing across the financial spheres like a mantra. Yet, beneath the surface, the currents run deep, and the challenges are manifold. While the external shocks that once fueled the inflationary fire, energy costs chief among them, have begun to subside, a new beast has emerged: domestic drivers, including wages, corporate profits, and productivity. The volatility that has gripped the markets in recent months is, in part, a product of unfavorable statistical effects, a byproduct of the peculiarities of the pandemic era. The launch of a low-cost nationwide transport ticket in Germany a year ago has skewed the data, as has the sharp decline in energy costs that has not been repeated this year. But to dismiss the current surge as a mere statistical quirk would be a grave mistake. The national reports from the economic powerhouses of the Eurozone, Germany, France, Spain, and Italy, paint a picture of a relatively even acceleration across the board, with prices rising more quickly than anticipated in most corners of the continent. At the heart of the matter lies the services sector, a domain where inflation has jumped to a staggering 4.1% in May, as companies grapple with rising labor costs and consumers flex their newfound spending power. This key segment of the economy has become a bastion of concern, prompting many officials to hold off on declaring victory over the inflationary scourge. Despite the reservations of the markets, economists remain steadfast in their belief that 3 interest rate cuts will be necessary this year. Yet, even within the hallowed halls of the ECB, dissenting voices echo, with figures like Bundesbank President Joachim Nagel questioning the need for further reductions beyond June's inaugural move. On the other hand, France's François Villeroy de Galha argues that the option of a July cut should not be dismissed outright, a stance that underscores the delicate balancing act the central bank must perform. Fabio Panetta, a member of the Governing Council, has struck a measured tone, cautioning that even with several cuts in the key interest rates, the monetary policy stance will remain tight. His words echo a sentiment shared by many, that prompt and gradual action is the key to containing macroeconomic volatility, lest a tardy and hasty approach exacerbate the turbulence. At the crux of the matter lies the thorny issue of workers' pay. Negotiated wages rose more robustly than anticipated in the first quarter, setting off alarm bells within the ECB's ranks. While the central bank has sought to diffuse concerns, pointing to one-off payments as the culprit, other indicators suggest that a slowdown may be afoot. Yet, as Dutch central bank chief Klaas Knot has noted, the rise in productivity that officials had hoped would temper inflation pressures this year has yet to materialize, casting doubt on the ECB's projections. As the central bank prepares to unveil its latest quarterly forecasts this week, analysts polled by Bloomberg do not anticipate major revisions to the inflation outlook. For June, Bloomberg Economics nowcast points to a reading of 2.3%, a figure that takes the latest data into account but offers little solace to those hoping for a swift resolution to the inflationary woes. In the face of such uncertainty, the ECB finds itself at a crossroads, navigating uncharted territory with each step. The path ahead is fraught with peril, but also opportunity, a chance to steer the Eurozone towards calmer waters and a more stable economic future. As the world watches with bated breath, the central bank's next move will be scrutinized, dissected, and debated, for it is not merely a matter of numbers and statistics, but a reflection of the collective will and resilience of a continent determined to weather the storm. The road may be long and winding, but with a steady hand on the tiller and a watchful eye on the horizon, the ECB stands poised to navigate the choppy waters, charting a course towards a brighter, more prosperous tomorrow.